Welcome to the deep dive. Today we're plunging into, well, the pretty essential world of digital assets. Our mission is to untangle three really fundamental concepts for you. First up, stablecoins, those cryptocurrencies designed to try and keep a consistent value. Second, we'll tackle securing your digital assets. It's a minefield out there with ever-present threats. And finally, we'll explore how you can actually earn cryptocurrency through mining and staking.
Yeah, exactly. We've basically gathered a whole stack of sources, everything from really detailed reports to some surprising facts. We're aiming to boil it all down to the most important insights for you. The idea is to help you understand not just what these things are, but really why they matter, how they're fundamentally reshaping finance, and crucially, what that means for you navigating this, well, pretty dynamic space.
Right. Get ready for some, hopefully, aha moments. We're about to get you up to speed quickly and thoroughly. Okay, let's get into it. So let's kick things off with stablecoins. It's kind of a paradox, isn't it? In the, often wild world of crypto. Why do we even need something called a stablecoin? What are they actually trying to do?
Well, at their heart, stablecoins are basically cryptocurrencies engineered to hold a stable value. Usually they're pegged one-to-one to a fiat currency like the US dollar. That's the most common way. The goal is really to blend the good bits of crypto, speed, global reach, that sort of thing, with the predictability of traditional money, trying to avoid those extreme price swings you see with Bitcoin or Ethereum. Which brings us to the key question. How do they actually do that? How do they maintain that peg?
Yeah, exactly. And that's where our sources break it down into like four main types. First, you got your fiat collateralized ones. These are backed by actual fiat currency or cash equivalents held in reserve somewhere. Think of the big names here, like USDT Tether and USDC from Circle. Those are major players.
Right. They're supposed to have $1 in the bank for every digital dollar issued. Supposed to. Then second, you have crypto-collateralized stablecoins. These are a bit different. They maintain their peg by being backed, usually over-collateralized, with other volatile crypto assets. You often see this on platforms like MakerDAO, with DAI being, the prime example there.
Over-collateralized, meaning they hold more crypto value than the stablecoins they issue to cover potential price drops.
Exactly. It's a buffer against the volatility of the underlying crypto assets. Third category, algorithmic stablecoins. Now, these operate without direct collateral backing. Instead, they rely purely on algorithms and market incentives, supply and demand, essentially to hold their value.
Right, and this is where we saw that huge blow-up, wasn't it, Terra USD? It just completely collapsed back in May 2022. Went from $1 down to basically zero.
A really stark example of the risks there. When the algorithm fails or market confidence evaporates, there's nothing underpinning the value. And finally, the fourth type. Commodity-backed stablecoins. These are pegged to physical assets, most commonly gold. Pax Gold or Tether Gold are good examples of that category.
Okay, so four different ways to try and achieve stability. But what's the point? What roles do they actually play in the ecosystem?
Well, they play some really critical roles. It's quite insightful when you dig into it. First, they act as a volatility hedge, a safe harbor, if you like. Users can move funds into stable coins during big market dips to kind of sit out the storm.
Right, park your money without exiting crypto entirely.
Precisely. They're also indispensable for crypto trading. They act almost like a digital dollar on exchanges, allowing for really fast blockchain-based financing between trades. And beyond that, they're fundamental anchor assets in DeFi decentralized finance.
Okay, explain DeFi's role here a bit more.
Sure. In DeFi, stablecoins are used everywhere. In lending protocols, in automated market makers, AMMs, which are like decentralized exchanges. Think of swap pools like Curve. Stablecoins provide both the stability needed for these systems and can generate yield for liquidity providers. Plus, they enable near-instant, low-fee cross-border payments. You can send value across the globe without needing traditional banks, and because they're programmable tokens on a blockchain, they can be built into smart contracts for, automated finance, tokenizing real-world assets, all sorts of things.
Okay, so for a user, the big benefits sound like price stability, less worry about wild swings.
Relatively speaking, yes.
Speed and efficiency for moving money around.
Much faster than traditional banking rails, often.
Financial inclusion, maybe, since you don't always need a bank account.
That's a key potential benefit, yes. Access for the unbanked or underbanked.
In composability, they kind of act like Lego bricks for building DeFi apps.
Well put. They're foundational, but, and this is a big but, every innovation, especially in finance, comes with its own set of risks and drawbacks.
Right. Let's talk about those risks. You mentioned reserves earlier.
Yes. Reserve transparency and adequacy is a huge one. Some issuers, USDT historically, for example, have faced criticism for, let's say, limited or opaque audits about what actually backs their tokens. Even USDC, which is generally seen as more transparent, has held things like non-liquid corporate debt in its reserves at times.
And if those reserves aren't easily accessible, like actual cash or short-term treasuries.
Exactly. If there's a run or a crisis and they can't redeem tokens for dollars quickly because the assets are tied up or have lost value, that's a major problem. It undermines the whole peg.
Which leads directly to depegging events.
Yeah.
We talked about UST, the algorithmic one, but even the fiat-backed ones aren't immune, are they?
Not at all. USDT dipped significantly, down to about $1.85 back in 2018. And even USDC, often considered one of the safest, briefly fell to 88 cents during the Silicon Valley bank crisis in 2023 because some of its reserves were held there.
Wow. So stable definitely doesn't mean perfectly fixed. It's a reminder that there's always risk.
Absolutely. And zooming out a bit, there are broader concerns too. Centralization and censorship, for instance. Issuers like Tether and Circle are centralized companies. They can freeze user wallets or block transactions.
Usually due to regulations or law enforcement requests.
Yes, but that ability, that central control, kind of clashes with the whole not your keys, not your coins ethos that's so strong in crypto. You're trusting a central entity again, which naturally brings in regulatory pressure and systemic risk.
Regulators are definitely circling now.
They are. We're seeing increasing global regulation, things like the U.S. Genius Act proposals, the EU's MiCA framework. They're imposing stricter rules on reserves, audits, operational resilience, and there's a real concern that if one of these massive stablecoins failed, it could cause contagion, not just in crypto, but potentially impacting broader financial markets.
Like a domino effect.
Potentially, yes, especially as they become more integrated. And then there are the ongoing illicit finance concerns. Their speed and pseudonymous nature can make them attractive for money laundering, scams. USDT, in particular, has often been highlighted in reports related to illicit activities and use by sanctioned groups.
And lastly, just the tech itself.
Yeah.
Operational vulnerabilities.
Yeah, smart contract bugs, cyber attacks targeting the issuer or related platforms, counterparty failures. All those standard digital risks apply. But, as you said, there are efforts to mitigate these.
What kinds of safeguards are emerging?
Well, regulation is pushing for regular, independent, third-party reserve audits, verifying that the reserves actually exist and are held in high-quality liquid assets, think cash, short-term T-bills. There's a push for stronger capital requirements for issuers, too. Enhanced AML KYC anti-money laundering, and know your customer protocols are being rolled out to try and curb illicit use.
Making it harder to use them anonymously for bad stuff.
Trying to, yes. And some proposed legislation, like the Stable Act discussions in the U.S., even looked at potentially limiting who can issue stablecoins, maybe preventing huge tech firms or non-financial companies from dominating the space to avoid too much power concentration.
Okay, so wrapping up stablecoins. What's the main takeaway for someone listening?
I think the key takeaway is that while stablecoins offer really critical functions, bridging crypto and traditional finance, they are complex and carry significant risks. That pursuit of stability, especially with fiat backing, ironically pulls them back towards the traditional financial system and its regulations and centralization risks. It changes what crypto means for many people. As the regulatory landscape gets clearer and transparency hopefully improves, stablecoins like USDC with strong audited liquid reserves might offer a relatively safer option, but vigilance is absolutely key.
Right. Definitely not something to jump into without understanding the specific coin and its backing.
Yeah.
Okay, let's shift gears. This next topic is crucial. Keeping your crypto safe. The digital world, as we know, is full of threats, and crypto is certainly no exception. What are the big dangers we need to be watching out for?
Yeah, this is absolutely critical. And what's really striking when you look at the data and reports, most of the really large-scale breaches, the massive losses we hear about, they don't usually happen because the underlying blockchain itself, like Bitcoin or Ethereum, was flawed.
So it's not the core tech that's breaking.
Generally, no. The vulnerabilities tend to lie elsewhere. Compromised hot wallets, those are wallets connected to the internet. Human error is a big one. And flaws in smart contracts built on top of the blockchain, which really raises the question, where are the weak points? And it often comes down to the user or the services they use being the final line of defense.
Let's make this concrete. Our sources mention some notorious examples. These really highlight the scale of the problem. You have exchange hacks, like Mt. Gox way back when.
Ah, the classic. Yeah, between 2011 and 2014, they lost something like 750,000 Bitcoin, worth almost $500 million then. Wiped them out. That was a mix of weak security, potentially internal fraud, just weak controls all around.
And it's not just ancient history. Bitfinex in 2016, $72 million gone through a multi-sig vulnerability. Coincheck in 2018, over $500 million in NEM tokens lost from hot wallets.
That Coincheck hack really spurred Japan's regulator into action, forcing exchanges there to use cold storage and undergo audits.
Then KuCoin in 2020, nearly $300 million lost from hot wallets, though they managed to recover a lot of it. And more recently, our sources mentioned a huge one, Bybit in 2025, a $1.5 billion cold storage breach via social engineering.
Yeah, that alleged Bybit breach, if the reports hold true, would be one of the largest ever. Highlights that even cold storage isn't foolproof if people can be tricked into giving up access. Social engineering remains a huge threat. There was also Novitex mentioned, an Iranian exchange facing a politically motivated hack leading to massive losses and shutdown. Shows the geopolitical dimension too.
And it's not just the big centralized exchanges. DeFi and smart contract exploits are a whole other beast.
Absolutely. Poly Network in 2021, $610 million drained by exploiting cross-chain communication flaws. Though, interestingly, most of those funds were actually returned by the hacker, but it still showed the massive vulnerabilities that can exist in complex DeFi protocols.
Underscores the need for rigorous security audits of smart contracts.
Definitely. And the wormhole bridge hack in 2022, over $300 million lost, exploiting a flaw in an upgrade that hadn't even been fully deployed yet. Tiny bugs can have catastrophic consequences.
And beyond these massive platform hacks, there are threats targeting individuals directly.
Oh yes, lots of them. Phishing and fake wallets are rampant. Malicious apps, fake browser extensions pretending to be legitimate wallets like MetaMask or Phantom, designed purely to steal your private keys or seed phrase.
That seed phrase is like the master key to everything, isn't it?
It absolutely is. Never, ever type it into a website or app unless you are 110% certain it's legitimate, usually only during wallet recovery on the official software itself. Then you have things like dusting attacks. Tiny amounts of crypto sent to your wallet.
Dust. Why would they do that?
To track your activity. By watching where that dust moves, attackers try to de-anonymize wallet owners, linking wallets together, potentially identifying high-value targets. Social engineering and insider threats are huge too, tricking customer support, bribing employees. There was an incident mentioned involving Coinbase support where compromised access potentially exposed thousands of accounts.
And the really scary one, wrench attacks.
Yeah. Sadly, that's physical coercion, literally threatening someone to force them to reveal their keys or transfer funds. It highlights how, as crypto value grows, personal, physical security can become a factor.
So it all paints a pretty scary picture, but brings us back to your point. The user is often the final security layer. What can people actually do? What are the best practices?
Okay, this is the crucial part. There are concrete steps you can and should take. First and foremost, use cold storage. Seriously, keep the vast majority of your crypto holdings offline. Hardware wallets like Ledger or Trezor are the standard here, or even paper or metal backups for your keys.
Keep it off the internet entirely.
As much as possible, yes, for significant amounts. And consider multi-signature or multi-sig setups for added security. That requires multiple keys to authorize a transaction.
Okay, cold storage is number one. What else?
Enable strong authentication everywhere you can. Use hardware 2FA keys, like a YubiKey. They're much more secure than SMS-based two-factor authentication, which can be vulnerable to SIM swapping. Use a strong, unique password for every single service. A password manager is essential for this. And look for exchanges that have things like secure asset funds. Binance's SFU is an example. It's like an insurance fund for users in case of a hack.
Good tip.
Beware of phishing and scams. Be incredibly skeptical. Always double, triple check website URLs manually. Never click suspicious links in emails or messages. And I'll say it again. Never enter your seed phrase anywhere prompted online unless you initiated a recovery process yourself in the official software. Educate yourself constantly on the latest scam tactics. They're always evolving.
Vigilance is key there. Okay, what's next?
Keep software updated, all of it. Your operating system, your browser, your antivirus, and especially your crypto wallet software and any browser extensions. Updates often contain critical security patches.
Basic digital hygiene, but crucial.
Absolutely. Then, relatedly, practice key hygiene. Don't store your private keys or seed phrases digitally, not in emails, not in cloud storage, not on your computer's hard drive if you can avoid it. Use offline methods. Paper, stored securely. Metal plates are even better for durability. Think fireproof, waterproof storage.
Treat them like crown jewels.
Pretty much. Next, choose trusted services. Deal with reputable exchanges and wallet providers. Look for ones with a proven track record, strong emphasis on cold storage for customer funds, maybe insurance coverage, regular security audits, and clear incident response plans.
Do your research on the platforms themselves.
Definitely. And finally, just ongoing vigilance. Monitor your account activity regularly. Check for any unauthorized transactions. Stay informed about new threats and vulnerabilities in the crypto space. It moves fast.
It sounds like a lot, but it's about building layers of security.
Exactly. No single solution is perfect. It's about layering these practices. And while the threats are real and evolving, it's also true that exchanges and protocols are getting better. More cold storage, better multi-sig, insurance. But ultimately, your personal diligence is paramount. Staying informed and proactive is the best defense for keeping your crypto safe.
Great advice. Okay, let's pivot one last time. We've talked about stablecoins for stability and security for protection. Now, how can you actually participate and potentially earn crypto? We're focusing on the two big ones, mining and staking. Let's unpack the core differences.
Right. These are two fundamentally different ways participants can contribute to a network's operation and security. One involves contributing computing power, the other involves locking up tokens. And in return for that contribution, they get rewarded with cryptocurrency. So the key questions are, how do they actually work? What are the upsides? And importantly, what are the distinct risks for each method?
Okay, let's tackle crypto mining first. This is the proof of work, or POW model.
Correct. Bitcoin is the classic example of proof of work.
So the mechanism,
Yeah.
it involves specialized hardware, right? You mentioned ASIC.
Yes. Application-specific integrated circuits. These are chips designed only to perform the specific type of calculation needed for mining a particular cryptocurrency, like Bitcoin's SHA-256 hashing. They're incredibly efficient at that one task, far more than general-purpose hardware like GPUs, graphics processing units, although GPUs are still used for mining some other cryptocurrencies. This hardware basically races to solve complex cryptographic puzzles, repeatedly hashing block data with a nonce until a valid result is found.
But a lottery, but based on computing power.
Kind of, yeah. The first miner to find a valid hash that meets the network's difficulty target gets to propose the next block and wins the block reward. And the network difficulty automatically adjusts roughly every 2 weeks for Bitcoin to try and keep the block creation time consistent around 10 minutes for Bitcoin.
And the reward itself, it changes over time. You mentioned the Bitcoin halving.
Exactly. This is really interesting. For Bitcoin, the block reward gets cut in half approximately every 210,000 blocks, which works out to about every 4 years. The most recent halving was in April 2024, and it reduced the reward for mining a Bitcoin block down to 3.125 BTC. So miners earn these newly minted coins plus any transaction fees included in the block they mined.
But you said it needs specialized hardware. Is this something individuals can easily do anymore?
Well, that brings us to scale and barriers to entry. Mining, especially for Bitcoin, has become highly industrialized. You have huge data centers filled with ASICs, often located where electricity is cheap. An individual miner with just 1 or 2 machines at home struggles to compete realistically in terms of the sheer hardware investment and, crucially, the ongoing energy costs.
So how do smaller players participate?
Mostly through mining pools. Individuals pool their hashing power together. The pool works collectively to find blocks, and then the rewards are shared out proportionally based on how much hashing power each member contributed. It smooths out their earnings. Instead of a tiny chance of getting a big reward, you get smaller, more frequent payouts.
Okay, so what are the overall benefits of POW mining? Why use this system?
The main benefit is network security. It makes attacking the network incredibly expensive. To rewrite the blockchain history, an attacker would need to consistently outpace the entire honest network's hashing power, which requires an immense amount of hardware and energy. It's usually economically irrational. And when that hashing power is spread out among many independent miners, POW supports decentralized consensus and makes the network resistant to censorship. No single entity can easily control transaction validation.
But it's not all positive. What are the big risks or downsides?
The biggest one, the one that gets the most attention, is definitely the high energy consumption. Bitcoin mining in particular uses a vast amount of electricity. Estimates vary, but some suggest it consumes energy comparable to entire countries.
Yeah, the environmental impact is a huge point of criticism.
It absolutely is. Though there's ongoing debate about the energy mix used, how much is renewable, etc. But the sheer scale of consumption is undeniable. Another major downside is that it's incredibly capital intensive. You need significant upfront investment in those specialized ASICs, which become obsolete relatively quickly. Plus, ongoing costs for electricity, cooling systems, maintenance. It's a serious industrial operation now.
Right. High barrier to entry, high running costs, big environmental questions. Okay, let's contrast that with the other main method, crypto staking or proof of stake, POS.
Yes, proof of stake works quite differently. Ethereum's move to POs with the merge is the most high-profile example. The mechanism here isn't about computing power-solving puzzles, it's about locking up tokens, staking them on the blockchain.
So you put your own coins on the line.
Essentially, yes. Participants known as validators lock up a certain amount of the network's native cryptocurrency. The network then chooses validators to propose and attest to new blocks, often randomly but typically weighted by the amount they've staked. More stake often means a higher chance of being selected. If they act honestly and keep their node online, they earn rewards, usually in the form of more native tokens from inflation and/or transaction fees.
But what if they misbehave? Or their server goes down?
That's where slashing comes in. If a validator tries to cheat the system, like validating multiple conflicting blocks, or has significant downtime, the network can automatically destroy or slash a portion of their staked funds as a penalty. It's the economic incentive to act honestly and maintain reliable infrastructure.
Interesting. So Ethereum made this switch from POA to pay your PS.
Yes, back in September 2022, it was a massive undertaking called the merge. And the primary driver and result was a drastic reduction in energy consumption. Estimates are often over 99% reduction compared to its previous POW energy use.
That's a huge difference. How does someone actually get started with staking? Is it easier than mining?
Generally, yes. The setup is much more accessible for individuals. You can run your own validator node solo staking. For Ethereum, this currently requires locking up 32 ETH, which is a significant amount for most people, plus the technical know-how to run the node reliably. But most people participate through other means. You can delegate your tokens to a professional validator via staking pools. The validator runs the hardware, and you share in the rewards and risks, minus a fee. Or you can use staking services offered directly by crypto exchanges or specialized staking platforms. They handle the technical side for you, making it very easy, though it usually involves giving up custody of your keys.
So much lower barrier to entry than buying ASICs and setting up a mining rig.
Definitely. You just need to own the tokens you want to stake.
What are the main benefits of staking then?
Well, for the individual, it offers a way to earn passive income on your crypto holdings. Ethereum's staking yields, for example, have typically been around 3-7% APY, though it varies based on network conditions and how you stake. For the network, the huge benefit is energy efficiency. As we saw with Ethereum, POS consumes vastly less electricity than POW. It's much more environmentally friendly. It also enhances network security through those economic incentives. The staked capital acts as collateral, ensuring good behavior. And some argue it can help decentralize governance, as potentially more individuals can afford to participate in validation compared to industrial-scale mining.
Sounds appealing. But what are the risks involved in staking?
There are definitely risks to be aware of. First is market and liquidity risk. The tokens you've staked are locked up, often for a specific period. If the price of that token crashes while it's locked, you still lose value. And you can't immediately sell because of unstaking delays. Your capital isn't liquid.
Right, you're exposed to price drops and can't react quickly.
Exactly. Second is slashing and validator risk. If you're delegating and the validator you chose misbehaves or has technical failures, your delegated stake might get slashed along with theirs. You're trusting that validator's competence and honesty.
So choosing a reliable validator is crucial if you delegate.
Very much so. Third, if you're using staking pools or exchange staking, there's platform and smart contract risk. The platform could get hacked. The DeFi staking pool's smart contract could have a bug. You're introducing counterparty risk.
Adding another layer where things could go wrong.
Yes. For solo validators, there are also the technical requirements. You need reliable hardware, internet connection, and you need to keep your software updated. Significant downtime can lead to penalties, potentially slashing. And finally, there's ongoing regulatory uncertainty. How staking rewards are treated for tax purposes is still evolving in many places, and there's debate about whether certain types of staking could be classified as securities, bringing more regulation.
Okay, lots to consider there too. So bring it all together. Mining versus staking. How do they stack up side by side for someone choosing how to participate?
Yeah, comparing them directly really clarifies the different profiles. Mining, PW, solves puzzles with hardware. Very high energy use, needs specialized ASICs, GPUs, heavy infrastructure. Access is often industrial, high barrier for individuals. Rewards diminish with halvings, like Bitcoin. Risks are capital costs, operational costs, potential hardware centralization, volatility, environmental impact. Staking, POS, locks tokens to validate, very low energy use, can be done with standard servers or easily through pools exchanges, much more accessible to individuals. Yields based on stake amount and network conditions. Risks are market price risk on locked assets, slashing penalties, custody platform risk if not solo staking, technical needs for solo, and regulatory uncertainty.
And the environmental difference is stark.
Absolutely stark. POW has a significant carbon footprint concern. POS is generally considered environmentally friendly in comparison. But it's important to remember both models are ultimately designed to achieve the same goal: incentivizing participants to act honestly to secure and maintain the decentralized blockchain network. They just use very different mechanisms and have very different implications.
That's a really clear breakdown. We've covered a lot of ground today. We really took a deep dive into that quest for stability with stablecoins.
And all the complexities and risks that come with it.
Then the critical importance of security, how to actually protect your digital assets in this environment.
Yeah, focusing on those practical steps users need to take.
And finally, breaking down the two major ways to potentially earn crypto: mining versus staking.
Comparing those different mechanisms, accessibility levels, and risk profiles.
It's fascinating, isn't it, how interconnected all these pieces are?
It really is. Stablecoins offer that bridge, but bring regulatory challenges. Security is foundational, demanding constant user diligence. And earning through mining or staking requires understanding completely different technological and economic models.
So ultimately, if you want to participate successfully in this space, whether you're just using stablecoins, trying to secure your investments, or looking to earn,
Thorough planning, doing your own research, and continuously staying informed seem absolutely essential. The landscape changes so quickly.
couldn't agree more. Which maybe leaves us with a final thought for you, our listener.
As this digital asset space keeps evolving, and as regulators inevitably tighten their grip, how do you think these core elements, this ongoing pursuit of stability, the absolute necessity of robust security, and these diverse, evolving ways to earn, how will they interact and ultimately shape the future of decentralized finance? And perhaps more importantly, how will they shape your personal financial landscape?
Something powerful to mull over until our next deep dive. Thanks for joining us.